do, do. It's a good song before the show starts. Stay in the Oh, you can hear it. I can't hear it. Hey, welcome to the Closing Beat, everybody. Happy Thursday. How you doing? No joke. I literally, until 10 o'clock last night, I thought today was Wednesday, going to be Wednesday. I had my whole day planned out. I was assuming it was Wednesday. People were talking Thursday. I'm like, yeah, whatever. Let's get through Wednesday first. Wow, it's been one of those weeks. But we're here. It's Thursday. We do have Wine and Wealth tonight. I am ready. I just didn't think it was for another day. We're financial advisors that are better at numbers than the calendar, apparently. So apologies for that. Tonight's Wine and Wealth class, we'll just do it right here, maybe just hang out. We'll be on the retirement stuff. We're going to start talking about that. If you've been close to or near retirement, you've been thinking, maybe I get a help from an advisor. Well, I hope you choose us, of course, but we're going to start working with clients on that retirement thing, because with rates going higher, pension amounts coming down, people just deciding whether they want to retire or not, we need to make sure we got some ducks in a row first, kind of like a checklist before you land a plane, right? We're going to just check that checklist, go into some of the details here tonight, so I'll grab a glass of wine, come hang out with you. A much needed glass of wine after thinking that I had one more extra day, and no, unfortunately, I had that day taken away from me. So we'll do that, and that'll start at 8 o'clock Eastern. It's in the dojo. It's our portal there. You'll see a little button that tells you when we're live and everything, and I'll be hanging out with you tonight. Wow. Okay. So the concept of tonight is you're retiring soon. Now what do you do, right? So we'll focus on that. Also, notes from Jazz. You can always check in on how the markets are doing, how we're doing, updates, things like that. I like to write an email every weekend. It is not automated. I actually write the whole thing out. Eric helps every now and then, but we'll be doing that this weekend. And our FinTips free videos, of course, are focused this month of August on, hey, you're about to retire, right? What can we teach? What can we get you thinking about? So you can ask your advisor, or if you join us or with us, then you can ask us as well, and we can start working through that. Anyways, if we look at the stock market today, a bit of a mixed day, which is understandable, right? Totally understandable. We had a handful of earnings come out. Not too big of a deal there. But it's a day where the market is leading itself into overbought territory, extreme overbought territory, as referenced by how far away we are from the 50-day moving average there. The S&P, let's go on over there. S&P, there you go, finding itself what we would consider short-term extreme overbought there. If we use the 50-day moving average, we're about 7% above that there. September 2020 was the last time that we were greater than 7% away. And let me just try a real quick thing here. Go time frame, daily. Let's go back a couple years and just zoom out. I'll head on over here to September of 2020, and I'll go like this so we can zoom in. This is it right here. So we're plugging along. Everything's good. We get extreme overbought there. In other words, why would you want to pay an extreme high price for something if you're looking to invest? And ultimately, we did have the pullback in there, although this looks bigger than it really was. It was actually a fairly calm pullback. So what you do is go, we are extremely overbought in the S&P. Okay, do I want to go swinging for the fences here? Is this the most optimum time to be swinging for the fences? Of course not. You want to sit on your hands a little bit, take a little bit of a break, because even if we continue higher, up at the 200-day moving average puts you exactly as extended as we were in 2020. And so that would, you could use other data points, but if you just go back to the last one, you go, ooh, that's a little extended. I run the risk of paying too much for the market. So you mid to longer term investors, sit there, hang out, chill out a little bit, take the day off tomorrow or something, and relax, and let the markets come to you. Remember, the longer term investor is not timing the market by doing that, right? You're timing your deposits essentially, but you're letting the market come to you. When people say, don't time the market, a lot of times they're talking about day traders, right? It's very difficult, right? It's fun, but it's difficult. If you're a longer term investor, that's no different than you being a real estate professional or buying houses or getting into those, what do the kids do with the Airbnbs? Got a client that collects classic cars. You let the market come to you. There's nothing wrong with that, right? Nothing wrong with that at all. You would do that in any other aspect of your life. So roll with it there. Anyways, let's take a look. If we're looking around today, I want to point out a couple things here. Financials. There you go. So financials a little extended as well. This is the sector that over the last week has moved the most. So it has the biggest gain. It has the most extreme move to the upside. I say extreme, just relative to everything else. It's obviously it could go a lot more. But that's had the biggest move. It finds itself overbought. Over the last 5 days, it finds itself basically up 5%. So it's a rather rapid move there. Today, if you're looking inside of the financials, you can attribute some of the bigger names to helping it out. JP Morgan, Bank of America, I believe, was your best one. It had the best day today, 2.4%. If you go over to Schwab, okay, I guess you give it that one, 4% there. But as you're looking through the bigger names, you got Wells Fargo had a great day. That's helping lift. Those are the bigger weighted stocks in the XLF. So if you ever to look up the holdings, you'd find that those guys participate a little bit more than something like Hartford Insurance Group, right? Falls into the financials, had a great day, had a great run, but it doesn't have the same impact on the XLF or the financials like a Bank of America did, all right? So a little lesson there. Same for like Capital One. Great day. It's trying to come out of this downtrend, but it really doesn't have the same impact as if JP Morgan, Citigroup, Wells Fargo, Bank of America, and the like have better days there. So I'm point that out. It's a really close second place, actually. So if you look at the energy sector, I'm going to call it a tie. So the energy sector goes from essentially being neutral to a little bit higher than neutral. It's not overbought. It's not oversold. It's right there kind of in the middle. The tug-of-war game where nobody's winning is a great way to explain it. Materials, not the most exciting sector, but this has also had a good move there. And yesterday, a lot of the materials had a great move. Same with industrials. So I didn't catch why that was, but it's kind of the same story today. John Deere, back to the 200-day moving average. Whenever you look at that, usually people look at Caterpillar. Doing the same there. We'll follow along with, there you go, Union Pacific. Tend to look at like UPS, things like that. All good moves here. So I don't know what's going on there. The concept of maybe, hey, no recession. Oh, people are going to keep going and buying stuff. That is great. Moving in the opposite direction. Okay, consumer discretionary went from being extremely overbought to still overbought, but working its way back there. And then really tech hasn't done a whole lot. It's kind of chopped around in this area here. So the focus would be on financials, materials, and energy in the ultra short term with maybe a nod to communication services, because that's really fighting. I don't know if you watch communication services stocks or that individual sector, but it's really fighting to try to come out of those lows. And Disney would have been the helper here today, if you were following along there. I do have to point out, well, let's go over to the Nasdaq, right? Yeah, let's do that. So we'll go over to the Nasdaq today. Extremely overbought as well. The Nasdaq yesterday finds itself in a new bull market, unless we're changing that definition too. But a bull market is 20% off of a low. So when the market makes a low, rallies 20%, you say, hey, that's a new bull market there. Are you diving in head first? Back in the truck up, as they say, dumping all that money into the market? We're still down 20% from these highs over here, which you can see. So it's still a discount, is it not? We're 20% off lows, but 20% off highs. Longer term investors, you might say, I like the area, but I just would like it to pull back. I'd rather buy on a down move. Totally understandable. Nothing wrong with that either. Now, new bull markets. We're going to take a look at that. I want to show you the performance of a new bull market. So what we did is we said, let's just look at every time the Nasdaq, now this is Nasdaq specific, rallied 20% off of a low after being in a bear market. So if we pop on over here, this should be the chart. Yeah, it is. Okay, cool. Here's the forward performance. Now, what we always like to do is show you forward performance relative to if you just blindly invested and never thought much of it. So over the next month, after the Nasdaq rallies 20%, confirms a new bull market, the average performance is 3.4%. It outperforms itself over the long run. Right? So if you just blindly put money in over a 1 month period, it's about 1% as you could expect to make over the long run. If we go out 3 months, the average move in the Nasdaq, remember, it's more volatile than the S&P. It actually beats the performance on the way up and on the way down. So you're riding a Bronco, as we like to say. But you've got an average performance of 2.9%. In other words, you would expect to average 2.9% over a 3 month period. If we're just looking back, how far did I go back? I want to make sure. Went back to the last one on record here that was in this calculation was 1974, October 1974. All right, so we're not saying the lifespan. Then you have a 3 month performance after starting a new bull market of basically 10%. So it's worthwhile to have this on alert that the Nasdaq is in a new bull market. Is it worthwhile at that very second that it hits a new bull market to get in? Well, no, because now we know what we have. We have a short-term, extremely overbought Nasdaq, but that's triggered an event that causes people to get excited about it. So it's a buyable pullback statistically, but not right at this very, very second. All right, over the 6-month time period, it outperforms itself as well. The average performance, 6.1%. 13.9 would be your average performance for a new bull market, and then we can say the same for 1 year. So worthwhile to take a look at, but it's going to be a bumpy ride. Case in point, if we go back to 2008, 1 month later, the Nasdaq was actually down 8%. Ultimately, it did finish higher over the next year, up 38%. Okay. But did you have to buy it the second it turned into a bull market? No. If you look at 2001, these are both wild times, actually. So 1 month later, down 16%. And that one actually finished negative for the rest of the year. That took you through the dot-com bust, actually. 1974, down 11%. 1978, down 3%. So you could see that in a 1 month time period, a pullback is okay. It will come for you, right? Just relax. Don't chase. Don't fear missing out. You will not miss out. You will be just fine. So that's something to, just try to, I try to keep you guys nice and slow. When the timing needs to be slow, let's just slow down a little bit, right? It's very easy to get sucked up into it and say, oh, I missed. Let's dive in. Let's buy. Practice being dead inside. So we've got gold pulling back a little bit. Uneventful asset class at the moment. Crude oil is not uneventful, but it's not really trending. It's not aggressive, and you never want to play counter trend in oil. That's a disaster. Speak from experience. You always want to play with the trend on this one. So if you're looking to be a bull in oil, it would be a very light nibble with the hopes that it changes trend for you, and you can work your way into a position. What else do we have? In the S&P today, real quick, mixed bag. Oops. Microsoft, a little bit lower on the day. Disney gets the pass on the way up there. But you've got things like Alphabet, the big dogs inside of the S&P. They gave you no love. There was just nothing there. They've had a good run. They're ready to take a break. So there's no need to really zoom into the entire market. You could just kind of look around and go, are the top 5 to 7 stocks doing anything special? No, they did, but they're a little tired. Apple just ran up a very steep hill. You ever run up a really steep hill? You're going to take a break when you get, somewhere up that hill. That's exactly what's happening in the stock market. All right, let's move on then. Disney's in the news. I bet you knew that. This is going to be earnings related. So Disney beats on earnings there. We talked about it yesterday. They're going to do the whole ad-supported stream. They're going to raise their prices there. Subscriber numbers came in better than expected. Park performance in Paris. Holy cow, if you break out their park performance and you go, ooh, Shanghai, still some work to do there. Paris actually killed it there. They're raising Disney Plus prices by, well, it's about 38%. It is still cheaper than competition out there, the average price being about $4.55 a month. They made a point to point that out. They are continuing to pull back their licensing to third-party licensees. So basically, they're getting all control over all of their content, all of their assets, and saying you can only get it on Disney Plus. That's fine there. Cash content spread. I thought this was interesting. It's expected to be $30 billion for their fiscal year 2022, which is actually lower than what they previously said. They're going to spend $30 billion. So that's just on creating content. Whoa. They said losses will continue in this fiscal year here. They pulled out of a couple different negotiations with the Indian Premier League, and they were going to be able to stream the Big Ten events. They pulled out of that as well, but made a point to say we're still bullish on sports. Just didn't work out with those two. We're going to work something else out. They've got a whole bunch of new content coming out. One of them I thought was interesting. Marvel's She-Hulk, Attorney at Law. I don't know that one. I've never seen that one there. Hocus Pocus 2, finally, after all this time here. So a lot of stuff going on there with Disney. A lot of what happened. So their money from parks and experiences, a lot of the beat came from that. Revenue change is 70% year over year. So the parks starting to get some dollars coming in there. The Shanghai park, still lost, was still basically declining there. But Paris and the U.S. killing it. In particular, Paris. Rather fascinating. Look at that. They added 14 million Disney Plus subscribers. Now they have 221 million. They were shooting for, I think, 300 million or something coming up. I didn't save that one there. ESPN Plus subscribers up 53%. Remember, that was the dog of Disney for a while there. They were having a hard time getting that done. Apparently, Bob Chapek can do something right, because that's impressive. They're also going to use their free cash flow, which wasn't much. I think it was $180 million, $190 million. Use that to reduce some of their debt. And remember, I always say, operate your personal finances just like companies do, right? There are different tax advantages, of course, but the way they budget their money, the way they choose to pay off debt, AT&T is a great example, and now Disney's a great example. They're reducing the amount of money that they borrow by $1.4 billion in the next quarter. Think about that. They're no dummies. They're like, we like to borrow money. We use that leverage to go and help our parks and build Tron, the mega coaster, and all that stuff. But they're like, we're going to scale it back $1.4 billion. Because it's more expensive. It's 100% more expensive for them. So you think the same way. Is now the time to go borrow a ton of money? Come on, man. Maybe not, right? Credit score don't matter. It just costs you more. Bumble in the news there. That's earnest. That's earnings. It was an okay beat. Here's what happens with stocks when they report earnings. It could be any stock. This one down 8.6%. If your earnings numbers, your actual results, don't have a shocker somewhere, like, oh my God, look at the revenue change there. Your sales are off the charts. That's great. Or you miss or something like that. If it's just right in line and everything's kind of fine, then everybody looks to guidance. You could tell me about guidance. What's going on there? Makes guidance the focus, and unfortunately that was lower for Bumble there. The Bumble app itself, their core product, did really well, but not Baidu, Badu, which is an international app there. That one did not do so well. I'm trying not to sneeze with you guys here. There. Bless you. Thank you. I saved it. Anyways, moving on. Going over to stocks in the news. Other than that, it was just kind of earnings. I don't want to make it seem like more than it really is. Cardinal Health happens to be a stock that we own. We're happy to see that move to new highs there. Earnings were weaker than expected, but the CEO is stepping down. Don't worry, the CFO is taking over. Investors typically like to see that. A familiar face taking over that has the experience. Dillard's, people shopping there apparently a lot. Revenue's better than expected. Store sales were right in line. That beats me. I didn't know we still shop there. I know it's a public company, but my gosh. Sonos was a pretty big miss there. Their CFO is actually leaving the company, and a couple other lower, not C-suite guys, but a couple lower management, they're also leaving. Stock made it new lows. That's 25% in one day. Ouchie. Tomorrow, nothing really in terms of earnings coming out. And that is because it is Friday. You typically do not see a lot of bigger names report on a Friday. Very common there. And so I'll take your questions if you have any. And we'll do what we do here. Otherwise, we'll get ready for the wine and wealth. You guys talking to each other. I didn't have something political to say today. I was trying to think of something just to get you guys going. You know what I mean? Get the chat going a little bit. Yeah. Oh, man. The Bears have been eating for a year. I don't know what you're... Oh, you guys... Somebody's bullish, somebody's bearish. There we go. Hey, that's what makes a market, though. Right? It's like the stock market is the only place left where we can get along but have differences of opinions. I like that. So if that's what's going on there, you guys battle it out, man. I don't know how much pullback you would expect in the market, Giovanni. That's a tough one. So it's always tough to... it's tough to what do you call it? Project or predict the pullback. You kind of got to watch it there. I like watching the pullbacks there. Yeah. You're a bull in the Chinese stocks there. All right. Well, you got your breakout of the downtrend. You've got your pullback after that breakout. Hopefully that holds for you. Kareem's got nothing. That's good. I did my job then, man. Dustin, Texas leaving the union. Yeah, that's a weird hypothetical. I'm more of a fact and numbers kind of guy there. And you gain access to the dojo. Your money is tied up in employer-sponsored 401k. Yeah, we don't really do that. We have a research site which gives you access to the research tools and stuff. jazzwealth.com/research. But it wouldn't be the full, just in full transparency, there'd be nothing to display to you other than classes and the research tools, because everything else in there is like client performance and how things, all their positions and stuff like that. Hey, Dustin, I've always wondered if your stable sources of income can support your expense, does that lead to a thought to take more or less risk in the market? That's a good question. I have clients that there's no way that someone like an Edward Jones or a larger company, Raymond James, would let them take the risk that we take here. But I can see that we can go full force. We're not going to do any damage. They're still going to be successful. Ultimately, what I do is, as we go through the planning phase with clients, the last part for me is the investment part. And I try to say, hey, if you want to take less risk, here's exactly how much less risk you can take. And here's what accounts you can do them in. If you want to scale back, have at it, but you don't have to. So it's just a matter of if you lose sleep at night. I love pointing that stuff out because it's, there is a level of risk that you can take for a given reward, right? Or a presumed given reward. It's not linear though. And so many people think like it's linear. No, it's the same on both sides. If you were to plot it out, it looks like this. So I love to really fine tune that stuff. That's the fun stuff that they do in mutual funds, right? To define a certain type of risk, they actually plot all that out. That's just my background. But it doesn't go like this. More risk, more reward, unfortunately. Otherwise, I'd be shooting for as much reward as possible. What do we got here? You like First Solar? You're playing with that headline risk, as they say. Yeah, you would expect First Solar to pull, but you wouldn't want to be a buyer. I wouldn't want to be a buyer. Very, very, very extended. What we could do is use maybe we'll do it tomorrow or something, but you use the research site and you say, okay, well, how extended is this? I would go like this. So we're basically right in here somewhere. Where's the thing? So we are about 50% away from the 50-day moving average. And I just use that as an arbitrary indicator. You can use anything you want. You say, well, how often, when First Solar has had a 50% move in, a couple weeks, how often does it go up another 50%? 5%, right? And if it does go up another 5%, what was the drawdown in between? That's the kind of fun stuff I would look at for you. Yep. You like the small quantities and sell big when you got to... Hey, I don't disagree with that. Yeah. Don't disagree with that. Well, I've got you guys covered here for today. I will be back here a little bit later for the Wine and Wealth. We will find some wine somewhere. So I'll be here. We'll probably just leave everything as is. We'll see you later in the dojo. You guys, the rest of you, enjoy the rest of your day. Thanks so much for watching. I appreciate it there. Adios.